Coming up on Business Incorporated, South Africa's GDP rises 6.3% in Q4 2020. And Fitch Ratings Agency expects Ghana's debt to hit 75% of GDP in 2024. And World Bank approves $440 million to support railway safety and service quality in Egypt. Hello and welcome to the program. I'm Ladi Williams. Let's get the show started with intraday market numbers from the African continent, which were mostly in the negative territory. Nigeria's index reversed Monday's positive sentiments, declined 0.80%, while the GSC in South Africa rose 0.62%. As data released showed the country's GDP rose 6.3% in the fourth quarter of 2020. In Egypt, the EGX 30 declined 0.53%, and Kenya closed negative on Monday. Just like in Monday's session, sentiment in Middle Eastern markets were mixed. That intraday markets in the UAE were negative, as Abu Dhabi's index shaved off 1.79%, while Dubai's index was marginally lower by 0.07%. Elsewhere, the Qatari index jumped 0.65%, while Saudi Arabia's index added 0.61%. European stocks were mixed this morning, struggling to extend a rally in the previous session that saw Germany's DAX rise 3.3% and hit a new intraday high. Let's get more now from Chelsea Delaney. Hello, Chelsea. Great to have you. Let's start off with the tech stocks, where the Nasdaq was officially in correction territory yesterday after falling more than 10% from its February record. Tech stocks have surged since the pandemic began. Why are they now falling?
Well, since the pandemic began, we've seen a lot of growth in tech stocks. That's really been the shining star of this market. And many of these companies have benefited from lockdown measures. Companies like Apple, which has seen a lot of demand for its products due to people working more from home, Zoom, the home conferencing, the video conferencing software, Peloton, the stationary bike company. All of these stocks have soared as businesses soared. But investors are starting to reassess their outlook for the economy in the months ahead. So they're expecting more and more that economies around the world will start to reopen, that business will to some degree get back to normal. And so they're looking at these tech stocks and wondering if they're really worth the amount that they're trading for on markets. So there is some concern that these stocks have been overvalued. As well, investors are thinking more and more about inflation and whether monetary policy is about to go back to being a bit tighter. Very low interest rates have been one of the key drivers of this tech rally. So all of that's put a lot of pressure on tech stocks. And we have seen investors rotating out of tech stocks, dumping those stocks and buying other companies that are a little bit cheaper, companies that have been really depressed by the coronavirus. So we've seen, for example, airline shares start to rally, retailers, banks, all of these companies whose stocks have really been beaten down by the virus. And so it's not a total loss. For example, as you mentioned, the DAX was at a record high yesterday, and that's because some of these companies are really starting to take off as people drop these expensive tech stocks.
And the world's largest travel fair kicked off today in Berlin. The industry has been devastated by the coronavirus, and we're hearing there's optimism from the travel industry. Any leaders yet?
I'd say the travel industry here is trying to signal some cautious optimism about the months ahead. We heard ahead of today's event from the head of TUI, which is one of the major travel firms here in Europe, that they are planning to start flights again from Germany to Mallorca, which is a very popular holiday destination among Germans and other Europeans, starting as soon as the end of this month. Other travel companies or other airlines like Lufthansa have expanded their offerings for the summer to tourist hotspots in Greece and Jamaica. And this is really dependent on vaccine rollouts, increased testing, as well as some sort of vaccine passport, some sort of certificate that would show who's been immunized. So far, all of those efforts are really getting off to a slow start here in Europe. The vaccine rollout has gone quite slowly. Testing is not nearly as widespread as it needs to be for the reopening of travel. So while these companies companies are increasing their offerings and saying that they do hope to be traveling by the summer. So far, we still see a lot of travel restrictions in place. So many of these companies are not really out of the woods yet in terms of reopening of travel.
Anyway, we'll see how that goes. Frankfurt's stock exchange is about to get one of the year's biggest European initial public offerings. Phone giant Vodafone says it expects to raise billions of euros by listing its mobile phone towers on the Frankfurt Stock Exchange later this month. Can you tell us more about this?
Well, yeah, this will be a big win for the Frankfurt Stock Exchange. One of the biggest initial public offerings of the year is going to be coming here to Frankfurt. Vodafone is one of the telecommunications giants in Europe, and they plan to list their subsidiary that includes all of their phone towers in Europe on the stock exchange. They're hoping to raise somewhere between 2 and 3 billion euros from that. This comes as a lot of telecommunications companies, a lot of phone companies have been making similar moves. There's a lot of demand right now for internet connectivity, in part because of the growth of remote working, as well because of these 5G rollouts, the next generation wireless networks that are going, that are starting to happen across Europe and the rest of the world. So a lot of these phone companies are looking at how much demand there is now for the technology that phone towers supply, and saying now is a good time to be putting these companies on the market. Vodafone does expect a lot of interest in these new shares, and for Frankfurt, this would be a big company for it. The new firm is expected to be valued at around 15 billion euros once it hits the market in the middle of this month.
All right, we'll keep tracking that IPO. Thanks for the update, Chelsea, and do enjoy the rest of your day. And now to London. OECD Paris-based leading economic think tank and its new interim economic outlook says global economic recovery is actually in sight. Let's cross over to Juliana now for updates from London. Great to have you, Juliana. And so this leading economic think tank, OECD, has upgraded its forecast for global growth to 5.6% this year. Where is the UK in all of this?
Yeah, hi, Laddie. Well, the UK is right up there at the top with an improved economic outlook. The last time that the OECD looked at the UK economy, which was in December, and I believe it was about a 4.2% growth in 2021 and a 4.1% growth in 2022. It's vastly improved now. It's up to a 5.4% growth this year. It's pretty much in line with the Bank of England and the British government's own Office for Budget Responsibility. No surprises that one of the reasons why we've seen this improved outlook is because of the vaccine rollout. Unlike what's happening on the continent, Britain is storming right ahead with the vaccine, and we have started to see the restrictions being eased. That began yesterday with children going back to school. There'll be a further one on Monday, and then soon we are starting to see that the economy will begin to tick again. Of course, it hasn't been a great year for the UK. We are one of the worst G7 performers when it comes to the economy and how it's coped with the pandemic over the past 12 months. And that's really because Britain is a service-based economy, and we do rely on people seeing each other, particularly when it comes to hospitality. We managed to scrape ourselves out of a double-dip recession because we had that 1% growth of the economy in the final quarter in December. We are expecting GDP figures to come in on January, not expecting on Friday. We're not expecting those to be great. We're expecting to see a contraction of 5.4%, but consumer optimism is improving, and that goes hand in hand with what the OECD have predicted.
All right, it's great to have some optimism there, but let's look at trade. Now, new data from Germany shows UK-Germany trade slid in January. Is Brexit to blame for this?
Brexit is to blame, but if you have a look at the full picture of what's happening in Germany, it's not just Anglo-German trade that's fallen. We're also seeing that across the continent, many putting that obviously due to COVID restrictions, particularly when it comes to importing and exporting. But you're absolutely right. Brexit is up right and centre when it comes to one of the reasons why we're seeing trade falling. We had heard from lots of British businesses, particularly retail businesses, saying that there was just way too much bureaucracy and red tape that have been forged because of that Christmas Eve Brexit deal from the 1st of January. There are so many new export and import measures that many companies have had to contend with, that some companies have just decided to put them off altogether, which is why we are seeing this fall. We're seeing not just a fall in imports coming from Germany to the UK, which I believe are down by 29%. We're also seeing it go the other way. There's been a fall of German interest in British goods by 56%. It does appear to be a big topic. It'll be a topic that will worry Boris Johnson and Chancellor Rishi Sunak, because we do know that Germany obviously is Europe's biggest economy, and making sure that trade flows backwards and forwards between the two companies is of the utmost importance. These figures do look at January. We do know that, of course, Brexit in January was pretty difficult because people are just getting used to lots of these measures. So I suppose both sides will be hoping that as the months go on and as the data continues, this lockdown and this slowdown will reverse itself.
All right, we'll keep tracking those numbers to see if there's any improvement. But bring us up to speed on the market numbers and what's driving sentiment today.
It was a pretty dull start on the FTSE at early trading. It's picked up at intraday. This is mainly down to precious metals. So if you're in the precious metals game, it's been a great day for you. The shares have been rising as much as the prices have been rising for silver and gold, although we have seen that miners are what's really been dragging down the FTSE. But nevertheless, it's in the green at intraday. The FTSE All Share is up 0.49%. The FTSE 100 is up by 0.43%, and the FTSE 250 is up by 0.64%. The British pound still going well against the dollar. It's up by 0.35%, though it's down on the euro by 0.15%, and up on the Japanese yen by 0.23% at intraday, Lade.
All right, Julian, thanks for the update. Always great to talk to you. And Asia-Pacific markets traded mixed today after starting the week by struggling for gains in what some analysts have described as fragile environment for stocks. In Australia, the benchmark ASX 200 trimmed some of its early gains, but still finished the session up 0.47% at 6,771. Japanese shares initially struggled after market opened, but the Nikkei 225 raised early losses and closed up 0.99%, while the Topix index advanced 1.27% to 1,917. South Korean shares fell, with the Kospi closing down 0.67%, while the Hang Seng index in Hong Kong advanced 0.24% in late afternoon trade. Chinese mainland shares fell, with the Shanghai Composite closing down 1.82% at 3,359. And the Shenzhen components fell 2.8% to 13,475. And Dow futures were higher in early trade this morning, putting the index on track to extend its rally from the regular session overnight. Dow futures rose about 103 points. S&P 500 futures gained 0.41%, and Nasdaq 100 futures rose 0.62%. On Monday, the Dow Jones Industrial Average rallied more than 300 points on investor optimism about the economic comeback from the pandemic. Bullishness was fueled in part by the Senate's passing of a $1.9 trillion economic relief stimulus bill on Saturday, which is set to include another round of stimulus checks. And oil prices rose in early trade today, and expectations of a recovery in the global economy after the U.S. Senate approved a $1.9 trillion stimulus bill and a likely crackdown in crude oil inventories in the United States. The world's biggest fuel consumer, Brent crude futures for May, rose 0.8% to about $68.77 a barrel, while the U.S. West Texas Intermediate crude for April rose 0.7% to $65. A stronger dollar and receding fears of a supply disruption from Saudi Arabia, the world's biggest oil exporter, after an attack on its export facilities, capped price gains. On Monday, Brent crude oil prices rose above $70 a barrel after Yemen's Houthi forces fired drones and missiles at the heart of the Saudi oil industry, including a Saudi Aramco facility at Ras Tanura, vital to petroleum exports. And commodities market update is next after the break. Do stay with us. Welcome back. We're talking peppers on our domestic commodities market update today. Peppers come in various forms and prices. The most widely consumed being the Scotch bonnet, bell peppers, chili peppers, and for some that want it a little more spicy, they use the Cameroon pepper. The demand for pepper is considered to be price inelastic because even though the price changes, it's not followed by a corresponding increase or decrease in the quantity demanded. Let's talk more about this to Pelumi Oshode, a research analyst at financial derivatives company. Hello, Pelumi. Great to have you.
Good afternoon. Thank you for having me.
Great to have you. So what are the prospects of scaling up the production of peppers in Nigeria, which is currently estimated at roughly 72,000 tons? How can we get it to commercially viable levels?
Like you rightly said, pepper is a widely consumed commodity in Nigeria, and the current supply we have right now is not enough, to cater for our domestic demand. And this shows that there is a demand gap which should be filled. And typically when there is demand gap, is actually filled either by importation or smuggling through, through like legitimate means of bringing in the commodity into the country, and eventually the prices will push upward. So in Nigeria, we need to increase our production capacity so that we can at least meet our domestic demand, and of course take advantage of ASCFTA so that we can export to neighboring African countries. And this can be done by, first and foremost, improving the quality of land used in production. And secondly, we should increase the quality of seedling that we plant. And of course, we can also improve through application of fertilizer to increase the yield per hectare, and also funding to this sector. This will, of course, scale up production and make the production viable, and of course, can push up to international markets and compete. And we have the capacity to actually compete on international market with other Asian countries like India and China. So if we can do all this, we can push in the market.
And the price of peppers has been relatively stable until recently, when there was a blockade in the north, which led to a major spike in prices of most other condiments and spices such as onions and tomatoes. Is this because of the complementary demand with these ingredients for making African sauce that drove up the price of pepper?
Typically, commodities with complementary demand usually have a direct relationship. An increase in the price of one commodity would have a corresponding increase in the price of the other. And this has played out in pepper, tomatoes, and onions. Increase in price of tomatoes and onions that we see in recent price definitely has an impact in the increase in the price of pepper, because these commodities are jointly demanded, and we can't substitute them for each other. We can't substitute tomatoes or onions for pepper. These commodities are actually, they have no substitute. So we can say to a very large extent, the prices have been pushed, aside the fact of seasonality. The increase in price of onions and tomatoes significantly have pushed up the price of pepper.
All right, let's look at price now. The basket of pepper is currently at 7.5. This is a 50% increase from 5,000 naira in February. What is responsible for this hike, and what is the outlook for the price and demand in the near term?
Like I said, seasonality has come to play. We are actually entering the planting season, and this season we expect that the supply of pepper would reduce drastically, and this will definitely push up prices. But because, like you said, this commodity has no substitute and is price inelastic, there might not be corresponding decrease in the demand for this commodity, although the price might increase because there might be supply shortage owing to seasonality. However, there might not necessarily be a significant decline in the demand for this commodity. So we all expect that the price of this commodity might push up slightly in coming months. However, the demand might not necessarily decline, because it's a major commodity used in almost every household in Nigeria.
All right, Pelumi Oshode, thank you so much for the update. Thank you for your time.
Thank you.
All right, so our latest data released today by Statistics South Africa shows that the country's economy grew 6.3%, largely as a result of further easing of COVID-19 lockdown restrictions. The Statistician General, Mr. Risenga Maluleke, however, announced that the year-on-year real GDP dropped by 7%, which was the first negative since 2009. Take a listen.
We were releasing today the results of our economy on the fourth quarter of 2020, where we say our economy rose by 6.3% from the production side. And of course, as it rose, we also looked at the overall performance for 2020, that is all quarters, where the economy fell by 7%. Now, when we look at the quarter on its own, we are realizing that all industries grew in the positive, with an exception of mining as well as finance. But these ones did also shed some jobs in the quarter in question. Whereas when we look for the entire year, we look at the entire year of 2020, we have realized that when the economy fell by 7%, only two industries, that is agriculture and government, rose in the positive. And we also looked at our provinces. The province of Gauteng had the highest performance at 0.6% growth. And of course, as it does so, it is followed by the Western Cape, followed by KwaZulu-Natal. And these are the three provinces that have the biggest contribution to the economy of more than 50%. Actually, Gauteng has about 34% contribution to the national GDP.
And now to West Africa. International ratings agency Fitch is projecting that Ghana's debt will hit approximately 75% of the gross domestic product in 2024. According to Fitch, the debt will continue to rise in 2021 and 2022 due to high COVID-19 pandemic-related spending and realization of energy sector liabilities. Fitch says Ghana's public finances are complicated by a history of domestic arrears and by contingent liabilities that will continue to add to its public debt stock. The ratings agency adds that the country's energy sector faces both a stock of debt outstanding and ongoing losses that is due to inefficient operational environment and wasteful tariff structure. And the World Bank approved a $440 million loan to support Egypt's initiatives to enhance the safety and service quality of the country's railways. The Railway Improvement and Safety for Egypt project cost is $681.1 million, including $41.1 million in a contribution by the Egyptian National Railways. The project will focus on modernizing the signaling for the Cairo-Giza-Beni segment of the Egyptian National Railways network and supporting the reforms needed to enhance performance and competitiveness. The ENR network comprises of over 5,000 kilometers of rail tracks and primarily offers passenger services for low-income Egyptians. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.